The people who understand silver the most, the ones who've been stacking for years, who know the fundamentals cold, who believe in this metal more than almost anyone, are the ones sitting on their hands right now. And that should tell you everything. Wednesday, March 4th, New York time. Comment your date below so I can see where you're watching from. If you value this work, subscribe and comment George Williams. It really helps. Because here's the thing. When the people who love silver the most start getting quiet, start watching instead of buying, you don't dismiss that. You lean in. You ask why. And the answer, when you actually dig into what's happening in this market right now, is more interesting and more important than most people realize. Let's start with where we are today. Silver is trading somewhere between $84 and $86 an ounce as of this morning. And on the surface, that sounds like a good story. The metal has had a massive recovery. It's moving. There's momentum. But to understand why so many experienced stackers are still waiting, you have to understand where silver just came from. Because the journey here has been nothing short of extraordinary, and not always in a good way. On January 29th of this year, silver touched an all-time high of roughly $121 an ounce. Think about that for a second. $121. People who had been stacking for years, who bought in the 20s and 30s, were sitting on returns they'd only dreamed about. The forums were electric. The sentiment was euphoric. And then, in just 8 days, silver collapsed nearly 47%. By February 6th, it had crashed all the way down to $63.85. That's not a dip. That's not a correction. That's a near halving of price in less than 2 weeks. And for anyone who was watching, or worse, anyone who bought near the top, that experience left a mark. Now, silver has bounced back about 32% from that February low, which is impressive, no question. But here's the math that matters. Even at $86 today, silver is still down roughly 33% from where it was just 5 weeks ago. So when stackers look at this chart, they're not seeing a fully recovered market. They're seeing a market that had a violent breakdown, staged a fast rebound, and is now sitting at a level where the next move is genuinely uncertain. And experienced investors know that the worst time to buy is often when the rebound feels the most convincing, right before the second leg down that shakes out everyone who got in too early. That's the psychology driving the caution right now. It's not fear. It's not a lack of conviction in silver. It's discipline. It's the recognition that smart money doesn't chase. It waits for confirmation. And confirmation hasn't fully arrived yet. But here's where it gets really interesting. Because even as stackers hold back on the short term, the long-term story for silver has arguably never been stronger. And this is the tension that makes silver such a fascinating market to watch right now. The fundamentals are screaming buy, and the chart is making you wait. The Silver Institute, the most authoritative body tracking global silver supply and demand, confirmed that 2025 was the 5th consecutive year of structural supply deficit. 5 years in a row where the world used more silver than it produced. And the cumulative shortfall since 2021 has now exceeded 820 million ounces. To put that in perspective, that is nearly an entire year's worth of global silver mining output. Simply gone, consumed, not replaced. And the projections for 2026 don't offer any relief. Another deficit of around 67 million ounces is expected this year, making it 6 consecutive years of the market running short. Now, in any other commodity, that kind of persistent deficit would have already caused a price explosion that everyone would be talking about. And in some ways, silver's January spike to $121 was the beginning of that conversation. But deficits alone don't move prices overnight. They build pressure, slowly, quietly, until something triggers the release. And that trigger is coming. The only question serious stackers are asking is whether it's already arrived, or whether there's one more dip before the real move begins. Part of what makes silver's demand story so structurally different from almost any other metal is where that demand is coming from. About 60% of annual silver demand is industrial. Not investment, not jewelry, industrial. And at the heart of that industrial demand is a reality that most casual investors completely miss. Silver is irreplaceable. There is no viable substitute for silver in high-performance solar panels. There is no material that matches its conductivity in the circuit boards and connectors being built for next-generation 5G infrastructure. The electric vehicle industry is consuming tens of millions of additional ounces every single year as EV adoption accelerates globally. And solar photovoltaic installations hit a global record in 2025 and are still growing. This matters enormously for anyone trying to think about where price floors are going. Because even in a scenario where investment demand falls off temporarily, even if stackers and ETF investors step back, industrial buyers don't stop. They can't stop. The factories need the silver. The solar installations need the silver. The grid needs the silver. That industrial floor is what makes silver fundamentally different from, say, cryptocurrency or even gold, where demand is almost entirely sentiment-driven. Silver has a built-in consumption engine that doesn't care about market psychology. And then there's something happening at the COMEX, the main US futures exchange where silver is traded, that is genuinely alarming if you understand what it means. Right now, COMEX silver futures are trading in backwardation. That's a technical term, but here's what it means in plain language. Buyers are willing to pay more for physical silver delivered today than for silver delivered in the future. That is the opposite of how commodity markets are supposed to work. Normally, you pay a premium for future delivery to account for storage and financing costs. When the market flips that, when people are paying up to get metal now rather than later, it signals that physical silver is genuinely tight. It's not manufactured hype. It's not a story being told on social media. It's market participants with real money saying they need the metal and they need it immediately. That kind of signal doesn't appear in healthy, well-supplied markets. So why aren't stackers rushing in right now? Because they're also watching the macro picture, and it's giving them permission to be patient. The Federal Reserve is expected to cut interest rates by roughly 50 basis points total over the course of 2026. But the timing matters. The market is currently pricing in only about a 2% probability of a cut at the next Fed meeting on March 17th and 18th. That means in the near term, the tailwind from rate cuts hasn't actually arrived yet. Lower rates weaken the dollar and make non-yielding assets like silver more attractive. But that dynamic builds gradually, and right now the dollar hasn't broken down convincingly enough to give the all-clear signal that precious metals bulls are looking for. Add to that the ongoing uncertainty around U.S. tariffs. The situation around Section 232 tariff policy remains unresolved in ways that could affect physical silver liquidity outside the United States. If tariffs eventually do land on silver imports, the effect could be a tightening of physical supply in the U.S. market specifically, which would be bullish for domestic prices. But the uncertainty itself is a reason to stay nimble rather than go all in. So what exactly are stackers watching? What's the signal that moves them off the sidelines? Most serious silver investors are watching one number more than anything else right now: $75. That's the critical support level. On the daily chart, silver has formed what technicians call a cup pattern, a large, rounded recovery from the February low. The base of that cup sits around $63 to $64. The rally since then has been the right side of the cup forming. But the integrity of that entire structure depends on $75 holding. A daily close below $75 would crack that formation and almost certainly invite a retest of $71, and potentially the 100-day moving average down near $69. And for many stackers, that scenario, painful as it sounds, is actually the entry they've been quietly hoping for. Because here's how disciplined long-term stackers think. They don't want to buy the bounce. They want to buy the dip that comes after the bounce if the bounce fails. A pullback to $75 or even $71 would feel terrifying to newer investors. But for someone who understands the 820 million ounce cumulative deficit, who understands the irreplaceable industrial demand, who sees the backwardation signal at COMEX, that dip is a gift. On the bullish side, if silver holds current levels and begins to build a base here with increasing volume and open interest on the futures side, the path back toward the January high at $121 becomes very realistic. And if that level gets retested and cleared with conviction, the next technical target, based on the full Fibonacci extension of the cup formation, lands around $136. Bank of America's metals research team has already put out projections ranging from $135 all the way to $309 by year-end, driven by the gold-to-silver ratio. With gold currently trading near $5,000 an ounce and the ratio sitting at roughly 59 to 1, silver is historically cheap relative to gold. In 2011, that ratio compressed to 32 to 1. Apply that same ratio to today's gold price, and you get silver above $156. The math is extraordinary, if you believe the ratio will normalize. That's the world stackers are living in right now. They hold a metal with one of the most compelling fundamental stories in the commodity space. They see the deficit data. They see the industrial demand. They see the backwardation. They hear Bank of America saying $309, and they are still waiting. Not because they've lost faith, but because they've done this long enough to know that patience isn't the same as inaction. Patience is a strategy. Waiting for the right entry isn't cowardice. It's how you maximize the return when the move finally comes. The stacker who buys at $75 after a pullback will feel much better about holding through volatility than the stacker who buys at $86 chasing a bounce. The metal doesn't care about your entry price, but your conviction absolutely depends on it. So if you're watching this and you're in that same boat, you believe in silver, you've done your homework, and you're just waiting for the right moment, you're not alone. The smartest people in this space are right there with you, watching, waiting, ready. Drop a comment right now and tell me where you're watching from and what price you're waiting to stack at. I read every single one. If this breakdown gave you value today, subscribe and comment George Williams. It genuinely helps this channel grow and keeps this kind of analysis coming to you for free. See you in the next one.